Stop scrolling and listen carefully, because this is not hype, this is not speculation, and this is not optional. Starting January 1st, a quiet switch flips that will affect every single person who owns crypto. XRP, Bitcoin, Ethereum, NFTs, stablecoins. It doesn't matter what you hold or how long you've held it. The damage doesn't happen immediately. It shows up later, quietly, when people open a document and realize they owe far more money than they ever expected. And by the time most people understand what went wrong, it's already too late. Here's what's coming, and almost nobody is prepared for it. Beginning January 1st, a new reporting framework officially takes effect. What happens during 2025 will be reported to the IRS in a way crypto has never been reported before. Not estimates, not guesswork, direct reporting. And the most dangerous part isn't that the IRS is watching, it's that the data being sent is often wrong, not slightly wrong, fundamentally misleading, and millions of people are going to trust it anyway. Before you assume this doesn't apply to you, let me ask you one simple question. Have you ever moved crypto from an exchange to another wallet? Cold storage, hardware wallet, another platform? If the answer is yes, this already affects you. Even if you never sold, even if you never cashed out, even if you think you did everything right. What changed is not crypto itself. What changed is how it's being reported. The IRS has introduced a brand new form called 1099-DA. This is real. It's finalized. And centralized exchanges are now classified as brokers under this rule. Coinbase, Gemini, Crypto.com, Robinhood, PayPal, all of them. That means they are legally required to send transaction data directly to the IRS based on your activity in 2025. And that data is going to be used whether it reflects reality or not. Here's the first thing most people don't understand. For the 2025 tax year, exchanges are only required to report gross proceeds, not cost basis, not profit, gross proceeds. That sounds harmless until you understand what it actually means. Gross proceeds is simply the total value of transactions the exchange believes were sales or disposals. It does not automatically mean you made money. It does not even mean you sold anything. It just means value moved in a way the system interprets as taxable. And that distinction is where things get dangerous. Most exchange backend systems do not properly distinguish between a sale and a transfer. Let me say that slowly because this is the core of the problem. If you move crypto from an exchange to a wallet you control, many platforms will classify that movement as a taxable disposal. If the price is higher at the time of the transfer than when you originally bought it, the system can flag that as a gain. No sale, no cash received, no profit realized, still reported as income. That is not a theory. That is how many systems already work right now. Now zoom out and think about the scale of this. Millions of users, years of activity, wallet-to-wallet movements, cold storage transfers, consolidations, internal reshuffling. All of that compressed into a single number called gross proceeds. When those 1099-DA forms go out in early 2026, a massive number of people are going to open them and panic. Because on paper, it's going to look like they made 2, 3, sometimes 5 times more than they actually did. And here's the part nobody is warning you about. The IRS doesn't need to audit you for this to hurt you. If you voluntarily report inflated gains, the damage is done. Quietly. Permanently. Most people assume that if a form comes from Coinbase or another major exchange, it must be accurate. That assumption is going to cost people thousands, sometimes tens of thousands, because these forms are designed for IRS visibility, not for your protection. They don't understand intent. They don't understand self-custody. They don't understand that a transfer is not a sale. Now let's talk specifically about XRP holders for a moment, because this group is especially exposed. XRP holders are far more likely to move assets off exchanges into cold storage. Long holding periods, fewer sales, more transfers. On paper, that looks like constant disposal activity. In reality, it's just custody management. But the reporting systems don't know that, and they don't care unless you correct it. Here's a realistic scenario that's going to happen to a lot of people. You bought XRP earlier at a lower price. Later in the year, the price is higher and you move it from an exchange to a hardware wallet for security. You didn't sell, you didn't receive cash, you didn't realize profit, but the exchange system flags that movement as a taxable event at the higher price. The 1099 DA shows gross proceeds. On paper, it now looks like you made money. When that form is sent to the IRS, the burden is no longer on the exchange, it's on you. If you don't correct it, the IRS assumes the number is accurate. That's how people end up paying tax on gains that never existed, not because they were accused of anything, because they trusted a form. And here's another uncomfortable truth you need to hear. Most tax professionals are not prepared for this. Traditional CPAs are trained on W-2s, 1099, INTs, stocks, bonds, and broker statements where cost basis is already reconciled. Crypto breaks that model completely. On-chain transfers, self-custody, wrapped assets, bridges, multiple wallets, multiple chains. If your CPA's entire crypto process is just give me the Coinbase form, you are exposed. It's not because they're bad at their job. It's because this reporting framework is brand new. The rules are evolving. The software is inconsistent. And most professionals rely on third-party reporting by default. If a form exists, they assume it's correct. They don't reconcile wallets. They don't reclassify transfers. They don't challenge mislabels. They just file what they're given. Tax software isn't a magic fix either. Some platforms capture nearly everything correctly. Others miss 10, 20, sometimes 30% of transactions. Some double count movements. Some misclassify internal transfers as trades. Two people with identical activity using two different tools can end up with wildly different tax outcomes. That alone should tell you this is not something you can blindly automate and forget. This is where most people make the worst possible mistake. They see an inflated number, they panic, and they either freeze and miss deadlines, or they hand the document to a CPA and say, just file this. That's how people overpay taxes legally, quietly, and permanently. The IRS doesn't need to chase you when you do their job for them. This is not about avoiding taxes. This is about not paying tax on money you never actually earned. There is a massive difference between tax evasion and tax accuracy. Accuracy protects you. Ignorance costs you. If you're finding this useful so far, this is the kind of information that saves people real money later. Stay sharp and stay informed. Now here's where this gets even more important. For the 2025 tax year, exchanges are not required to report your cost basis at all. Let that sink in. The IRS will see gross proceeds only. No context, no purchase price, no transfer intent, just a number. And starting in 2026, cost basis reporting will be added, but only for assets acquired after 2025 and only if they're held with custodial brokers. Anything before that falls entirely on you. So if you've been in crypto for years, moving assets across wallets, platforms, chains, DeFi protocols, the exchange will not fix that for you. The IRS will not assume you're right. And saying, I didn't know, will not protect you. The burden of proof has shifted. This is why preparation matters now, not later. The people who take time during 2025 to reconcile their history, classify transfers correctly, and document cost basis will avoid the stress entirely. The people who ignore this will learn about it after the damage is done. And make no mistake, the biggest risk here is not audits. It's overpayment. The IRS doesn't need to accuse you of wrongdoing when you voluntarily report inflated income. Once it's filed and paid, clawing that back is difficult, slow, and sometimes impossible. This rollout is happening in stages for a reason. 2025 is gross proceeds. 2026 adds more automation, more matching, more scrutiny. The system is tightening, not loosening. Treat this year as a preparation year, not a reaction year. The most dangerous assumption you can make is thinking the exchange handled it, so it must be right. These forms are designed to give the IRS visibility, not to protect you from errors. A transfer is not a sale, but the form doesn't care unless you correct it. And panic is the worst possible response. Most people will learn about this after they get hit. By then they're scrambling, arguing with CPAs who don't understand crypto, or paying thousands more than legally required just to make it go away. That's not compliance. That's an ignorance tax. The IRS allows you to correct cost basis, it allows you to classify transfers properly, it allows you to reconcile records, but only if you have the data and the knowledge to do it. If you don't, the default assumption becomes you made more than you did. So if you own XRP, Bitcoin, NFTs, stablecoins, anything, this is part of the new reality. Regulation doesn't just affect price and adoption, it affects you personally, at the tax level. Whether you traded once or 1,000 times, the people who stay ahead of this aren't smarter, they're just earlier. They care enough to understand the rules instead of reacting to them. That's the warning, that's the message. This is not legal or tax advice, it's education. Consult a qualified tax professional who understands digital assets. Verify everything yourself. Do your own research, protect your capital, stay prepared.